Success in investment starts with making sure you have the right tools, making sure you have the right books, that you understand terminology, that you're looking at the right thing, that you're surrounded by the right people, that you're listening to the right things, and that you do your own research. That's important. So let me start off by making sure that you understand what books you may want to take a look at, that I've taken a look at, that may help you out when you come into investment. So let's start off with that. Some of the authors I've looked at are Peter Lynch, Warren Buffett, and Dave Ramsey. Any books by those guys or lessons from those guys, take heed. It will make a world of a difference in your investment journey. Some of the books I have read, Next Door Millionaire, very good book. You never know who you live in next door. You ever see that person that's driving a Honda Civic that probably has $1 million saved up or probably been saving for 20 years? That's the person that's a millionaire living on under his budget or living below his means. Psychology of Money, very good book. Teaches you how to use money in different ways and understand that money is not the end all be all. The Intelligent Investor, Warren Buffett's favorite book. This will help him start his investment. Maybe something that you want to take a look at. Some YouTube channels that I recommend. Market Mondays, definitely Market Mondays. Three brothers over there teaching you how to invest, giving you the latest news, and just the tips and tricks of the stock market. Financial Education, definitely a good channel. It's about a millionaire now. He started at Quick Trip as a gas station, and now he's a multi-millionaire, and he's been investing for a long time. His videos are very informative, very educational. Also, Chris Sane. Chris Sane is another one. Very good individual, a brother. I like listening to him. He gives very insightful tips on, especially when it comes to options. I don't really know options. I don't really dabble in options. I don't really have time for it, but he does give tips on how to trade in the stock market. So now we want to begin with the vocabulary that I think you should understand as a beginner in investment. This is all raw. Like, I'm giving you the real. I'm not scripted, nothing scripted. These are all terms that I think you should know as a beginner investment. So let's start off. Some of the vocabulary. S&P 500. S&P 500. When you think about the S&P 500, you're thinking about the 500 greatest companies. These are companies that you drive by every single day. These are companies that you shop in every single day, such as like AutoZone, Walmart, Target. You probably wear Nikes. You probably have an Apple phone. You probably go on Google. You probably at work. You probably use all the Microsoft Office apps. Those are the 500 greatest companies that most of us invest in when we have a 401k. And if you have a 401k, you're probably investing to the S&P 500. Most individuals, especially when you're beginning, they always say, hey, you might want to start off buying something in the ETF or index fund of S&P 500. Now we're talking about the Dow Jones. The Dow Jones is 30 companies. It's a very old index. It's very heavily concentrated, but it has stocks like Apple, Nike, Salesforce, Amazon, and so forth. Then you have the NASDAQ. The NASDAQ is all technology companies. It's 100 technology companies, such as Tesla, Meta, PayPal, Uber, Apple, even has Pepsi in there. I don't know why I got Pepsi in there, but Pepsi is considered a NASDAQ stock. So those are 100 technology funds. And the equivalent of a NASDAQ 100 fund that most people tell you to invest in is called the QQQ. So triple Qs. You're going to hear that a lot. Triple Qs. That is an ETF, an index fund that very carries technology funds. Then we talk about ETF, exchange trading funds. Those are like index funds, but they trade throughout the day. So you can trade those. You really can't trade index funds. You really can't trade mutual funds, but ETF allows you to trade throughout the day. So sometimes you'll hear people shorten the S&P 500, or they're going long, which means they're buying and holding the S&P 500. So those are the ETFs that you can exchange and trade throughout the day. Index funds, on the other hand, they have a low fee for those, but they are just like a bowl of stocks. And it's very similar to a mutual fund, but a mutual fund is a bowl of stocks that requires a larger fee to hold a mutual fund. So let's talk about REITs. REITs are basically like, let's just say you want to own a piece of a property, of a store front, like, you know, most of like the Walgreens and your CVS's. That is owned by a large REIT company. that owns the land and owns the property, and they rent out that property to stores like CVS or Foot Locker, or even some malls like some of Simon properties. They're considered REITs, and they're basically just rental properties. So you're buying a piece of that trust, and you get proceeds from that trust when they get the money from those storefronts. Let's talk about the bear market versus bull market. A bear market basically means that stocks are just going down and down and down and down, which is a good time to buy because stocks will be on sale. A bull market means things are going good. Right now, we're currently in a bull market, and stocks just keep going high and high and high and high and high. There's nothing wrong with a bull market. You want a bull market, and don't ever run away from a bull market. Try to invest into a bull market, but you want to have some cash on hand just in case we ever go into a bear market, which is stocks going down. So blue chip companies versus dividend aristocrats. So blue chip companies are companies that have cash, that are producing, they have good revenue. We're talking about the biggest companies out there. We're talking about Amazon, Nike, some of the biggest companies, Tesla. They have cash. Nvidia, they have a lot of cash and they're producing a lot. You can count on them for the long haul. Those are blue chip. Dividend aristocrats like Pepsi, 3M, Campbell's, Johnson & Johnson. These are stocks that continue to increase their dividends, but maintaining their growth as they keep and continuing or increasing their dividends. So every year they always increase their dividends. They may even increase it every 5 years, but they continue to increase their dividends. These are called dividend aristocrats. Dollar cost averaging. So you're gonna hear that a lot. A lot of people are gonna say, hey, like let's say you ain't got enough money to buy a whole index fund. So somebody's gonna tell you, say, why don't you just dollar cost average? Dollar cost averaging is continuing to put the same amount of money into a stock every week. So let's just say you buy Apple every week. You're dollar cost and averaging, because what you're doing is you're buying Apple at its highest, you're buying it at its lowest, you're buying it at very different prices. But over the long run, you're buying it each time it goes down, up, but it's going like that. So you're dollar cost and averaging in. So you can dollar cost averaging $5, $10, $20, $100, as much as you have or little as you have into a stock, just to maintain and make sure you're getting it at good prices each time, because you can never time the market. So you just dollar cost and averaging that. Volatility. You're going to hear about this word volatility. All that means is the stock market is going down. So they're going to be like, oh, the market will probably be volatile for the month of October. That just means they're expecting some type of pullback or some type of stocks to go down or stocks to be on sale. So you're going to hear volatility or volatile a lot, okay? Dry powder. Dry powder, like I was talking about earlier, is having cash on hand when those bear markets happen or when there's volatility in the stock market. So you want to have some cash on hand, but they call it dry powder. So you're going to watch TV, you're going to be like, oh, what is dry powder? Dry powder just means you have cash, you're ready to buy the dip, you're ready to buy stocks that's on sale. Window dressing. Window dressing happens at the end of the quarter or at the end of the year. So what happens is these big old brokerage companies or firms, investment firms, they want to basically help tell their customers that they're doing a good job. So what they do is that they buy stocks that are already high and put them on their files. So when people look at their statements, they say, wow, he actually bought Amazon. They actually bought Apple. But meanwhile, they're just window dressing. And maybe next quarter, they'll probably sell those stocks. So right now, they're just showing off, basically letting you know, hey, yeah, I bought some Apple. Yeah, I bought Amazon. Yeah, I bought Dutch Bros. Yeah, I bought whatever stocks is doing high, they're window dressing, basically showing off, okay? Tax harvesting. Tax harvesting happened at the end of the year, where say if you have a lot of gains for the year and you want to just make sure your taxes don't take most of your gains away, so you start selling your losses. So stocks that are down for the 52 weeks, they start selling those stocks, which means you may be able to get those stocks on sale. It happens every year. Stocks that are doing really bad, they usually sell them off at the end of the year for tax harvesting, for tax write-offs, because you can write off your losses as a tax write-off to match your gains. That way it can balance it out and you won't get hit with big tax bills. Long-term trader, or a long-term investor versus trader and versus swing trader. Long-term investor, you buy S&P 500, you buy some stocks, and you just let it ride for 10, 20 years. Or it could be 5 years, okay? Trader, if you got a full-time job, it's hard to be a trader because you got to pay attention to everything that's going on. It's news, tweets, messages, a fire, assassinations, CEO quitting, new CEOs. You got to constantly pay attention to the news, and it can affect your stock when you're trading. So to have a full-time job if you're a trader is very difficult because you're constantly just trading every second trying to make money. A swing trader is somebody that holds a stock for about a week, a month, 2 months, 6 months. So they're just swing trading, making money on the swing. They may hold it for the reporting quarter, or they may hold it at the beginning of the quarter, but they usually just swing trade it 3 or 4 or 5, 6 months. A brokerage account. So when somebody tell you, hey, you need to open a brokerage account, that's basically opening an account for stocks. You got your regular brokerage account, you got your Roth brokerage account, you got your traditional IRA brokerage account. A brokerage account is taxable. The Roth isn't. The traditional is. Retirement accounts are Roth and traditional IRA. So if I were you, if you don't have a Roth IRA, if you don't have a pension, you want to basically open up a brokerage account for your taxable stocks and then open up a retirement Roth IRA. That way you'll have at least 2 amounts of money coming in along with your Social Security, especially if you're older. If you're younger, you might want to do both. You actually want to do both, but you're more focused on retirement because you got a long path, 40, 50 years. So, but for somebody who don't have money and you're about to retire and you want to retire in the next 15 years, get a brokerage account, start and put money in there, but put most of your money into your Roth account. So there's various brokerage accounts of various brokerage companies like Robinhood, Fidelity, Schwab, Chime, SoFi. There's a whole bunch of brokerage accounts that you can buy stocks and make money for retirement for the long term. So this is basically just giving you kind of like just easy terms to understand. I gave you some authors that you want to take advantage of. I gave you some books that you might want to start up. Look at some YouTubes. You can include me as well as a person that's going to give it to you raw and uncut. It's something I just started to learn myself. I'm not a millionaire. I would love to be a millionaire one day. I don't know if that's ever going to happen, but I'm definitely going to try to be a thousandaire. So if I can help you in your journey for retirement, at least for retirement, you'll have something, and you'll have something to be proud of. You can retire with dignity. Listen to the channel, subscribe, comment, because I'm definitely going to retire with dignity. I'm not going to be that person that don't have money when I retire. So if you want to learn more and you want to learn real, uncut, raw type investment training, none of the BS, none of the fluff, subscribe to the channel. I got a lot more education to give to you guys. So pay attention and subscribe to the channel. Like, subscribe, and keep it Econ 100. You already know.